Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. Today is Monday, it's the 19th of September, and my email address is rshaw@fxcm.com. Just going to bring up our disclaimers. Here's the high risk investment warning. Hope everyone had a good weekend. Here's our market commentaries disclaimer. Just keeping this on screen for a few moments. Hey, Rob. Very cool message. Thanks very much, and good luck. Nice. Here is our references. So we'll look at TradingView, Bloomberg. We'll take a look at the 5 things to start your day. And this is a big week. I think this is the week that history judges the Fed. So if I may be so bold to say it's that important. Let's start off with the first headline, which reads, "The hike race. Central banks are intent on driving the world economy perilously close to a recession." Late to see the worst inflation in 4 decades coming, and then slow to crack down on it, the Federal Reserve and its peers around the globe now make no secret about their determination to win the fight against soaring prices, even at the cost of seeing their economies expand more slowly or even shrink. About 90 central banks have raised interest rates this year, and half of them have hiked by at least 75 basis points in one shot. Many did so more than once in what Bank of America chief economist Ethan Harris labels a competition to see who can hike faster. Hey Anna, morning to you. Nice to have you on the webinar. Next headline, losing patience. The European Union unleashed an unprecedented punishment on one of its own, signaling that patience has worn out with Hungary and Prime Minister Viktor Orban's determination to engage with Russian President Vladimir Putin while eschewing the democratic values of the bloc. On Sunday, the EU triggered for the first time a process that may withhold 7.5 billion euros earmarked for Hungary unless it takes steps to curb fraud and corruption. EU governments must make the final decision within a month on whether to freeze Hungary's funding, with the possibility of extending the deadline by as much as 2 months. And defending Taiwan. US military forces would defend Taiwan if there was an unprecedented attack, President Joe Biden said, underscoring America's commitment to the island as Chinese incursions mount near its shores. Biden, speaking in a 60 Minutes interview that aired Sunday, distanced himself from a question of whether Taiwan is or should be independent, but followed up with a pledge when asked if US forces would defend the island. Biden has made similar statements before, spurring outrage in Beijing. Tensions with China have flared after House Speaker Nancy Pelosi visited Taiwan to signal support for its government and for democratic values. This is quite an interesting headline. The Porsche IPO. Volkswagen is looking to raise as much as 9.4 billion euros from the IPO of its iconic sports car maker, Porsche AG, in what could be Europe's largest listing in more than a decade. The German car maker said late Sunday it is seeking a valuation of 70 billion to 75 billion euros for the listing, below an earlier top-end goal of as much as 85 billion euros, with the deal going ahead at a time of deep market upheaval. Let me say that again, I beg your pardon. So they're looking for 75 billion euros, which is below the initial top-end goal of 85 billion euros. And this as there is deep market upheaval. European markets have been largely shut to IPOs for most of the year, with companies shying away from seeking new listings because of the region's energy crisis, rising interest rates, and record inflation. Coming up, European equity futures inched up as Asian stocks declined at the start of a busy week for the interest rate decisions. UK markets and government agencies are closed as global dignitaries attend the funeral of Queen Elizabeth II. World Bank President David Malpass addresses the Economic Club of New York. ECB's Luis de Guindos speaks in Madrid. I beg your pardon if I mispronounced. The OEC launches its 2022 State of Fragility Report, examining the impact of crises around the world. Expected data include Portugal's PPI, and that's for August. All right, let's see if we can make some money. Can retail investors buy an IPO? So the answer to that is yes. However, it depends on your broker. Okay, so typically what happens, Anna, is that brokers will get allocations to the IPO, and if you are a client, there may be a limit to how much you can make application for, but you can apply for the IPO, and that's the way it would work. So there would be an element allocated, one would imagine, to retail brokerages. And then, of course, once it's listed, then it starts trading on the secondary market. So that's an effectively the way it would work. All right. Let's take a look here at the real rate. The bottom chart shows the median CPI, and I think this is really the story. Banks are going to be hawkish until the sticky components of inflation start showing signs of moderation, and they haven't as of yet. This has now been updated. When we looked at the median CPI, I'm not sure if I got the right one last week, but it was a month short. So this is the latest. There's no signs of moderation here, and the problem with sticky inflation is that whilst the sensitive items will of course start rolling over, there's going to be a floor to how low the core series, be it CPI or PCE, can go if there is reluctance by the sticky components such as rent to actually start rolling over. So I think the central banks and the Fed in particular for this week are hell-bent on getting the median series to roll over. And I think that until we see signs of the sticky items starting to give way to the transmission mechanism, I think the central bank is going to remain hawkish. So I think Wednesday is an important day. The communication out of the press conference and the FOMC statement are going to be very important. Again, I think this is the conference that effectively judges this FOMC. We know that they have lost some credibility, but again, I'm not sure many could have done better. We came out of a very difficult pandemic period. They ran ultra loose policies. Yes, they should have understood that inflation was not transitory. But again, how many of us sort of could have handled this really strange situation? So I think this is where the judgments I think will start coming in. All right, Fed, you were behind the curve. We understand you had a difficult job, but now you're dealing with very sticky inflation. You're dealing with the aftermath of what clearly were policies that were too loose, and the policy mistake of not recognizing a more entrenched inflation. Deal with it. So this is kind of the make or break, and I think that in order to leave a legacy, so to speak, that is looked at. We talk about the Volcker years. Well, this is kind of the time to sort of make or break that. What one would think. That being the case, I think the median inflation number becomes exceptionally important for us. So we'll just continue to monitor that. One of the interesting things that we read in the Bloomberg email, of course, was, well, they're looking to potentially push economies into recession. I don't think they're looking to potentially push economies anyway. They're looking to manufacture the recession. There's no other conclusion one can draw. That being the case, the question then becomes not if there's going to be a recession, it's how hard or soft the recession is. And here we can look at another series, and that series is of course the inversion of the yield curve. So let's add that in at the bottom here, and then we can try and make some sort of inferences. So let's just go US 10-year minus US 2-year, and this is going to be very interesting in terms of how it looks how it looks at the end of the week, or come Thursday. I don't think I've put it in correctly. Well, let's just take a look at the 2-year for now. So the 2-year, you can see is at 3.87. So the 2-year is a good proxy for monetary policy, the front end of the curves. Before we look at the inversion, just something that's come to mind, let's take a look at the 2-year and the Fed funds rate. Let's overlay them. So thinking what's the best way to do this. I think I'll have to do it on a separate chart. I'll come back to that. All right, let's put in the inversion. All right, this should, yeah, there it is. Okay, and you can see it's really a huge movement last week. Okay, so inflation misses. There's no signs of moderation in that sticky part, and this is last week's move. So we're looking at the weekly. So before last week, the inversion was at a minus, let's call it minus 25 basis points. We're now at minus 42.2. All right, so just less than 20 down, and this is obviously going to change based on the communication that we receive on Wednesday. And I would suggest they have to be hawkish. Now, why would they have to be hawkish? Because of that sticky element. However, they run a risk of overshooting. So just like there was policy mistakes before, I think because of those policy mistakes, there is heightened probability of policy mistakes this time. And the idea is higher interest rates take time to work through the economy. I think we'll discuss that tomorrow. I'll just put together a few notes on how the transmission mechanism tends to work. And the idea is they may overshoot. And I think that's exactly what this inversion here is telling us, is that they are going to induce the recession. The idea here is, of course, is it going to be soft or hard? Now, the deeper the inversion and the longer the inversion lasts, the harder the landing. And it just looks from last week's movement in terms of the 210s, the Fed's quite happy. Well, the market expects the Fed to actually induce a fairly hard recession. Now, what we can take a look at is, of course, US GDP. That's one thing to take a look at. We can put that underneath this. But US GDP, we know, has been declining now for quite some time. So that's this this orange chart here. I'll just make it a little thicker. So here's the turning point. So from the 28th of June, GDP has, and this is on a year-on-year basis. On a quarterly basis, we've contracted. So we are, by that definition, in a technical recession. I think it's quite a weak definition, personally. I think that the year-on-year figures are better to look at. So it's rolled over. Where's the pocket of strength? That's in labor. Okay. So let's just throw this in. Sorry, I punched it into the wrong section, but doesn't matter. Just so here you can see the initial jobless claims, and isn't this amazing? Isn't this amazing that the initial jobless claims have come down? I don't think that's sustainable, but that's sort of just a feeling. Because if you're going to induce a recession, well, we've already seen that GDP. Okay, we've already seen GDP is coming down here. But if GDP is coming down, labor, one would think, needs to adjust as well. Labor is a lagging indicator. That's where where it becomes very difficult to assess. However, initial jobless claims theoretically should be coincident. So the fact that it's dropped here, I think, is quite interesting. Let's just take a look at this on a continuing basis. Okay, so it's also starting to tick down here. So it's just very interesting. And this perhaps does suggest elements of a softer type of recession. Again, I think we must watch this very carefully. I think the Fed is still aggressive. I think there's risk of overshoot here. And I think that there is an element to the labor market which theoretically should be susceptible to that. So we just want to watch that. Just one last thing, and then we're going to do some analysis just to see if there's opportunities. Let's just go through to that, the 2-year. And let's just throw the Fed's funds rate on top of that. And I'll just get some history here so we can. So you can see that the 2-year we're at 3.87 Fed funds rate. It's actually it should be the interest rates in the US would work in a band, but we'll just take a look at this, the 2.33. You can see there's a massive gap between where the market's expecting rates to where rates should be and where they are at the moment. Let's just take logarithmic off here because it's throwing this out. All right. Okay, there we go. That's better. So you can see that the correlation between the two are extremely strong, except for every so often there will be an overshoot, but the overshoots in the 2-year are really outliers. There's an overshoot there. There's a slight overshoot here. Okay, but by and large, the Fed funds rate mirrors the 2-year. So there's a big lag here. And that's why I think there is a real reason to believe the Fed's playing catch up, but that risk of overshoot is still there. All right, so that's what we're dealing with, a very complex environment. However, within that complexity, there may be some opportunity. Let's take a look at a few charts here. All right, so let's take a look at the main layout. All right, so I don't want to look at this chart because it's a crypto. We'll do this on Wednesday, but let's go through to the US dollar. Let's start off there. All right, let me just see, there's a few comments here that I've missed. No one knew that we're going to have the oil demand shock at that moment. Yeah, I think that certainly plays a role. I certainly would not argue against that. So, but before the supply shock, and I think there were elements that were suggesting the demand side inflation was more sustained. So we already know before February, so before the invasion of Ukraine, there was a huge, in fact, if we go all the way back to November last year, it was at a testimony on Senate Hill. Sorry, was a testimony on Capitol Hill in front of I think one of the Senate committees, where the word transitory was actually retired. So the invasion certainly complicated the inflation situation massively. There's no denying that. And I would also suggest, by the way, besides fighting sort of the actual physical conflict, one may postulate that Putin is timed this to fight an economic war as well, knowing that the supply shocks would exacerbate the already sustained inflation. So I think there's a lot to be said on that point. Rob's saying that PPI is falling. Is it correct to think that CPI should start to fall? Yeah, it's a very good point. Just before we take a look at the US dollar, let's just throw these together on the charts as well. I'm going to keep the core, a big one. I'm going to keep the median in. Let's just put in PPR. let's get rid of the scar. All right, so the PPI is starting to roll over here. And this, by the way, I think does factor in probably on that supply shock discussion sort of that we just had. So it's worth keeping an eye on that. And what is interesting is, let's throw in now the core CPI. Okay, we're putting the core. Yeah, let's add this as on a new price scale. And we've looked at this. Series previously. I do think it is a valid series. So thanks for bringing this up, Rob. It's probably something that we also need to watch. So I think that the key here is, of course, the crossovers. Just as a general signal. So in other words, it seems that PPI in these high stagflationary times certainly do lead the core. That's what it seems like. Now we've only got very few. We've got very few instances to refer to. We've only got the first oil crisis and we've got the second oil crisis. Nothing really beyond that. So two incidences don't make statistically it's very weak. We're looking at a very low sample size, but we've got nothing else to really work with. So I think that we can look at the inflation where we can look at the situation where the PPI was leading the core demand side inflation in those stagflationary environments. And you can see that PPI, which is the black series, leads the red series, which is the consumer number up. It does it over here as well, not quite as viciously as the first oil crisis, but there's certainly an element here that starts the run of inflation. And then what happens is the PPI turns down first, doesn't it? And perhaps in the second oil crisis, also a little bit sort of unclear there which one turned. Actually, looks like the core turned first, but nevertheless, the movement is very very close. What we can say though is that the PPI being below core CPI is certainly an element in the moderation of inflation. So the fact that PPI has pushed down here, Rob, I would suggest is something that is noteworthy. What's interesting here is I would think that a large part of the reason the PPI has turned down is actually demand induced. In other words, the demand destruction has led to oil prices coming down, just as an example. But I think coupled with that, we have seen food prices coming down, etc. If there is a crossover here, Rob, I would suggest that's something that we need to keep track of. So that is certainly a good point. Unfortunately, I don't have the median data just when we need it. We need it for 75 and 80. I don't have it. So I'll see if I can get my hands on that through the St. Louis Fed. But of importance, I think if we get a crossover in PPI and CPI, I would still suggest we need to see that moderation in median. It just seems the most sensible approach to me. If we don't get that moderation in median, there's really no ways we can reach that 2% target. So perhaps there is a linkage between the PPI, CPI, and median. So I think this is a good sort of model to keep an eye on. What's lacking here is sort of data here, which is actually really important. We need to kind of, because if we're using that model, we're actually blind because we don't see what's happening with 75 or 80. So that's something that I'll see if I can find. So that's a good point. Anna just writing, Putin picked his moment well. I think it was I think it was timed to perfection, Anna. You know, there was nothing random about it. That's my view. The economic fallout was very much part of the process. All right, let's take a look. Let's take a look at the US dollar here. So we know that we're in this environment where there is a hawkish bias. The dollar remains. Let's go through to the weekly here. The dollar remains very strong. So what you can see here is a clear primary trend that's moving in the northeasterly direction. Okay, we can put in a higher peak here because that's now. So we've got a series of higher troughs, higher peaks. This is a very strong trend, and the stochastic remains. What we can take a look here, just something that's coming to mind is, of course, the question that came up last week. Well, what about potential disruption to the US dollar basket from Japanese intervention? Like, in other words, if the Bank of Japan drops the intervention, does the US dollar basket take a knock? I would suggest it takes a bigger knock than the DXY. So what we can do is just throw in the DXY here, which is the trade weighted. It's got a much heavier weighting in euro. So we just bring up DXY here. Let's just add back the logarithmic nature. You can see the trend is seriously strong, even on the DXY side. I guess, you know, if there's any movement on the Bank of Japan side, we'll have to monitor that as well. So you can just see how many variables are at play here. I keep talking about monitoring. A lot of things to monitor. But on the US dollar basket, the FXCM basket, no doubt that there is strong underlying momentum as we go into Wednesday. If you take a look at the daily chart, this is where it gets super interesting, because take a look at stochastic. It's just crossed into that upper quintile. So now we're in that upper quintile. In other words, and we'll talk more about this actually in the day trading course, right? Is that now that we're in the upper quintile, we ask the question, well, how long is it going to stay in the upper quintile? Because that's where it's going to develop another swing. If it stays there, here's where it maintains in that upper quintile. Here's where it gets a superb swing. We've now just moved into that upper quintile. How long do we stay there? Well, monetary policy suggests for quite some time. We of course don't know that. Okay, there's no guarantee here, but we are in the zone 1. We have just moved into that upper quintile, just moved into it. In fact, putting in a line just to monitor as a sort of for an academic type of, well, how long did we stay in this momentum area? Let's just take a look at this over here. Okay, you can see there's an expansion in the Bollinger there. Over here, I don't think there's going to be an expansion in the Bollinger here because there's no real squeeze. But what I think is going to happen with this Bollinger, I think it's going to start moving in that northeasterly direction, a little bit steeper. So that would confirm sort of trend. And if we go now down to the hourly chart here, well, you can see the signals are clear. Okay. So we've got the signal R1 acting as a headwind at the moment, but we're pretty close to breaking into the upper quintile on the hourly. We get into that upper quintile on the hourly and we hold, then there's a swing. If we don't make it into that 80, okay, then R1's held up, and there may be some sort of positioning ahead of the FOMC. So this looks like it's a fairly decent level. So going in long at this moment, you must recognize that you're at a confluence of resistance, R1 with price resistance, and the stochastic hasn't quite signaled the strength yet. But by and large, working on that top down, okay, I would suggest any sort of weakness or dips here become exceptionally compelling. Let's take a look at Euro. And Euro is very interesting. I'm still holding my my short here. So I put a short on last week, and I'm still holding it. And I want this to I want this to build. Okay. I want this to build. Okay, this was a little bit of heartburn here. Okay. This is a little bit of heartburn, you can see. All right. But the stop wasn't hit. All right, so just taking a look here, we've got lower peak, lower trough, lower peak, lower trough, lower peak, lower trough, lower peak. Okay. Do we get? Can we take this question mark off? We'll know at the end of this week. I suspect any strong words out of the FOMC, it drives us lower. Any surprise, of course, would be a huge surprise, and we get a rally. That would be crazy. You just can see how weak the euro US dollar has been here. Just crazy weak. And if we go through to this chart, okay, so we've rolled over, okay, but there's a squeeze. Okay, so the market's anticipating the volatility. Do we get the aggressive hawkishness? I think 75 is probably what's going to happen. I don't see 100 because 100 would certainly send the right signal, but it would do, I think, some serious damage to. I don't think it's appropriate management of the economy, but there is a 26% chance. I think it's 26% of 100 coming in. No, it's not 26%. It's 21%. Sorry, 21%. Okay. So I think 75, and then I think there's a strong message that comes out of that, and I think that if it's a very strong message, we move into zone 3, and I think we get the stochastic moving to its lower quintile. All right, so this was hard, but the stop's now been shifted down. So any kind of adverse effect here probably will get stopped at. But the whole idea here is, do we get the momentum? Without the momentum, nothing's happening. So kind of just sitting in this for a week. You know, it's tough because the swing hasn't developed. Let's take a look at DAX. All right, so what we have here, I think, is interesting again. We looked at this last week. I made an error here. I brought up the euro US dollar, and then I think it was Anand Gurdy corrected me. But so this is an interesting chart. I think this is a really interesting chart because we don't actually have a trend here on DAX, but we're getting pretty close to one. Let's just take a look at this in terms of the triangle. Remember we said there's a consolidation that's going on because we don't have the lower peak followed by the lower trough. What we've actually got is the lower peak followed by a higher trough. Well, that's exactly what a pattern is. Okay, patterns are just variations of peaks and troughs. So it looks as if now the lower boundary is starting to get challenged, which is something I think we insinuated or suggested is probably the line of least resistance. You can see that the stochastic is heading into that low quintile, just like the dollar has just moved into the upper quintile, while the DAX looks as if it's just about to move into its lower quintile. In other words, we could be on the cusp of a swing here, of the next. So it looks as if this is going to break. Okay, and I think that the catalyst here is monetary policy. And if we do break, then forget about the consolidation. Okay, look at the trend. Then we've got, let's make this a reference peak. Let's make this a reference trough. Okay, here would be the lower peak. Now we don't have the lower trough yet, so we don't have the downtrend. All we've got is that consolidation, but we're pretty close to taking this out. And we're pretty close to that lower trend developing with a real dangerous momentum setting, because this is strong momentum down, right? Take a look at the daily chart. We've just moved into zone 3. Okay, stochastic on the daily rolling down. Do we get to that 20 level? And if we do, how long do we stay there? So it's looking very fragile going into Wednesday. The 5 points, the email that we read this morning suggested Europe was looking to bounce, even though the Asian session was down. That was interesting when I read that, because I was thinking that just sounds odd. And you can already see here that it's rolling over. It's already rolling over. Okay. If it gets here again, then the swings, you know, there's a huge potential for that swing if we get to that 20 and hold. So it's looking like a very fragile week at the moment, and I think for good reason. 79% of the market's looking for 75 basis points. 21% of the market's looking for 100 basis points. I think we get to 75. I think 100, whilst an argument can certainly be made for 100, I think it's going to be disruptive. I think that we've mentioned that this is the, I guess this is the meeting that makes that history's going to judge, right? So maybe 100 comes in and it's the right call. I don't know, but I would suggest you want to kind of carry on monitoring your data. If you start seeing signs of moderation in that median, if we, as Rob suggested, if we get that crossover in the PPR, core CPR. So these are all things that are in play at the moment. Do we get them or not? I think that 100 just might be a bit heavy-handed. That's just a gut feel. 21% of the market suggests otherwise. Any questions? Please go ahead and type those through. Any questions? Go ahead. It's a big week, and I think it's going to be a very interesting week. Thursday, guys. Thursday is the start of our 5-week day trading course. I'm blown away by the amount of response that we've got. I'm actually really nervous about it because there's been a lot of interest. So, it's got to be a good one. I'm sure it will be. If anybody needs the link for that, just send me an email and I'll happily send that over. Just a comment. I did chat with, or I corresponded with Anna last week. EU won't be able to view it because of compliance issues. Nothing I can do about that. So, but I am aware of that. By the way, these sessions will be recorded and they will be made available at some stage, but there will be a lag from when they do get released. All right, I don't see any comments. So I think that we can wrap up here. Have a good day, good evening ahead, and then we shall chat tomorrow morning. Thanks very much, guys. I'm not sure, Anna. I'm not sure. I'll need a double check with the compliance. Again, it's really driven by regulation. So will the recordings be made available for the EU? I would imagine potentially if we can put in some sort of disclaimers. I'm not sure. Let me double check for you. I can't actually be definitive about that. I will check though. All right, guys. Let's wrap up and chat tomorrow. Cheers.